mode of computation. It is a calculation or determining factor to quantumize the subsidy. That does not mean that it is towards the purchase of that particular asset. So it need not be reduced from the cost of that asset. So on the original cost, depreciation should be granted, and the subsidy need not be deducted from the cost if the intention were for backward area development, etc. But for purchase of generator specific, even diesel generator that is being purchased, now state government is giving a subsidy. That is only for purchase of generator. It is not the question of where you install, etc., etc. For purchase of a generator, since I am not in a position to support you with the power, you can have a diesel generator, and for the purchase of diesel generator, I am paying you the subsidy. You produce the bill, tell me the cost, on that 15% I give you, means that will go for reduction of the cost. So that is the Supreme Court decision on PJ Chemicals, and it is rightly followed by the Madras High Court in Standard Fireworks. Now, capital grant means it is totally a capital receipt. Within that capital grant, sometimes it can go to reduce the cost, like the diesel generator. Many times it need not go for reduction of the capital cost even when the intention is to go for a backward area development, etc. Then the next is about the revenue subsidy. Revenue subsidy by the nature itself, yes, it is an income. It has to be credited to the profit and loss account. It is an income chargeable under section 28. No problem about it. 80 JJA gives an exemption of 100% of the profit for biofertilizer and related area. For this biofertilizer, etc., what happens is these fertilizers are sold to the farmers, and the government gave, say, 50% subsidy, and the subsidy is received by the seller. He was asked to raise a bill for 50% on the farmer. The balance 50% will be paid to him by the government. So the revenue said this 50% what he collected from the farmer is on sale. The balance 50% is a subsidy from the government, which is just any other receipt. So it will not be eligible for 80 JJA. 80 JJA gave him a benefit of 100% profit. So that profit that department was not interested to give. So he said it is revenue, but that revenue is not linked to this. It is a separate thing. So 80 JJA benefit is not available. Then the court said there is only one sale, and for that sale the price is being received from two sources, one from the farmer and another from the government. So it is a revenue and is eligible for 80 JJA. Same thing will also be available for a windmill case also, if there is going to be some subsidy like that. Then most of the windmills, what happens is that 80% depreciation if it is installed on 30th September. After that, on 31st March means you get 40%. And a lot of orders will be given to these Suzlon and others like who are all in the windmill manufacturing business. These companies take the order and somehow see that on 31st of March it is installed. And they also take it up with the respective state electricity boards, and the state electricity board have to inspect it, give a certificate that it is worth or properly installed, etc. And power can be taken, or it is capable of producing, generating electricity, and that generation can be drawn into their substation. Because electricity generated, you need the support of the state electricity board. Only through them you can draw that out, you can receive it in the point where you receive it, where you want it, or without their support, your windmill can only be rotating, but the generation will not be there at all. So state government support is very much required. Through the electricity boards, it has to be drawn. Invariably what happens is, on 31st of March, you will get a certificate that the windmill is installed. The electrical engineer also will certify that. There will also be an agreement for power purchase if it is going to be given to them for 2 rupees 70 paisa or 80 paisa or 90 paisa, whatever it is. Then the first meter reading also will say initial reading 31st March. subsequent reading 15th May. So 15th May to 31st March backward, this is the power production, and for this is the rate. So now all these proof are all proof to say that the windmill was erected, it has started production, a commercial production has happened, and all that. In a particular case, what happened, I have just received a notice, the substation which can receive that power itself was commissioned only after 31st of March. So somehow that has now come, they are reopening it. So now the question is how to defend this case. So I have to fall back on and say there need not be a commercial production, but a trial production is sufficient. If there is a certificate issued by an electrical engineer without that plant being operated, without seeing a generation out of that, he cannot certify that. He cannot certify without getting at least one unit produced from that. So a trial production has happened. Yeah. No, I'll just come to that. I'll come to that. So what is this commercial production or trial production is? I say on 31st of March, I am keeping a deadline and say I am eligible, I have installed it, I have got it. So this production has happened. I am dependent on the electricity department, an external factor on which I don't have any control, and they are to draw that out. They may not have their substation ready or anything, but they have certified. The Vadivel joke, what happened for the electricity that was generated? That one unit also should have gone to the substation. So what that one unit that was generated, probably it gets lost in the transit even. So it is sufficient for me to prove that the windmill was capable of producing. I was not able to produce and supply it, probably due to there was no demand or there was any other factor. So production, it is put to use is the concept for this. So it is put to use, it is ready for use, is put to use. It need not have culminated into a commercial production at all. I have got two case laws on this. One is Nakoda Metals, wherein it was said that machines must have been used for the purpose of business. Whether the assessee is successfully able to commence commercial production or commercial production is delayed on account of defects in trial production does not affect the allowability of deduction on account of depreciation and investment allowance. Further, on Norplex Oaks case, Calcutta High Court, ready to use would satisfy the test of put to use. Just because the assessee did not get orders to use the machinery, he should not be deprived of the benefit of depreciation. This is more a logical part. I am ready. I am manufacturing something. But on 31st of March, though I have got the things ready, there was no order at all. When there is no order at all, where is the point of me manufacturing? So it is a commercial prudence that without getting an order, I don't start the production. But my machinery is ready. So depreciation has to be granted. And so also in TNEB case here, I have got it ready. It is capable of producing. Whether TNEB has drawn it or not is not my this thing. My table, that first bill says initial reading on 31st of March and the subsequent reading is on 15th of March. This in between time, some 200 units have been produced and they have paid me for the 200 units, whatever is the rate. So this will say that I am eligible for this depreciation. Next is, what about the shifting expenses? This is also a practical thing that happens. Before the installation of the windmill, the place is being technically scrutinized for the wind velocity, the wind direction, how many months wind comes, etc., various parameters, technically it is being analyzed. After all this analysis only, a windmill is being installed in a particular location. But in spite of all this, it may so happen that the windmill does not generate the optimum level or an acceptable level. So I am incurring loss. So in this situation, I compare it with other place, supposing it is at Kanyakumari means I compare it with a Palladam unit. So I look at it and say Palladam probably it is better than at Kanyakumari. So I take a decision of shifting the plant from Kanyakumari to Palladam. Now the question is, this transfer expenditure of transport, all other related expenditure related for the shifting, more big amount is with respect to the fees that I paid to TNAB. TNAB demands in lakhs for shifting of a mill. So once I shift this windmill from one location to another, a transfer fee is also paid to the TNAB. Now it came for the discussion about these shifting expenses, is it revenue or capital? The department said there is an enduring benefit. You were not producing till yesterday. Now you are going to produce, and from now on you are going to reap profit for any number of years. So there is an enduring benefit, hence it is capital. The assessee said, I have already failed. I have lost. What was originally expected did not come through. This expenditure I have incurred only to regain what I have lost. So it is a past thing what I have lost. I am not going to do anything much better or anything like that. So it is a question of survival. I have to survive first. So when it is a question of survival of that plant, survival here meaning financially feasible. Financially, when it is not feasible and this transfer was necessitated, it amounts to revenue. Against the assessee was a bimetal bearing case, where from Madras they shifted the unit to Coimbatore. There, the court split the total expenditure into two. One with respect to the expenditure related to workmen, staff and other laborers like as revenue, and that related to the machinery cost etc. related as capital. So this was cited by the department and they wanted it to be, since it is an undertaking, a machinery and total in one full set, it is capital. But fortunately in Loyal Fabrics, Super Fabrics case, a Clear Windmill case itself, enduring benefit is not something like your principle or your what they call it as verities. It is not an eternal verities. It is not a true principle or a belief on which you have to hold on. It has to keep changing with changing times. So what is the meaning of it now? What is the changing economic situation as it happens? So with the changing economic situation, look into the enduring benefit and don't be tagged on or tied on to an old principle of enduring benefit, etc. So it is a question of survival, hence it should be. So the test of enduring benefit should not be applied blindly or mechanically, and held expenditure should be revenue in nature. So this is about the shifting expenditure. Now we come to the next important part, which is 80IA. This 80IA is one which takes the department very much agitated. Somehow they do not want, they feel 100% profit is given as exemption. How to curtail it, how to stop it. So much of power with which they are working on every aspect of 80IA. Now this 80IA, what it says, 100% of the profits out of an industrial undertaking producing this power will be allowed as a deduction. It is not exemption, it is a deduction under chapter 6A, and the assessee can choose a period of 10 years to claim this benefit out of 15 years. Out of 15 years means from when? Probably they are, what he was asking. From the day it starts producing or generating or manufacturing. So that is the cutoff date. So that date. So if it is that date, 31st March, that date 31st March commercial production is the day from where 15 years starts. Years, so completed years only we go. Within these 15 years, you can take 10 years. Now what will be the 10 years that will be often? The first year, 100% depreciation, 80% of normal depreciation and 20% of additional depreciation, say. 100% is eligible. Who is putting up this? Only one who is already having cash rich, I told you. So he is having other business where there is good amount of profit. He is being lured into this and he invested and he will take this 100% depreciation or the entire cost as deduction. So a crore of rupees invested means he gets a benefit of 30 lakhs on tax saving. So that is being done. The second year and third year also, probably if it is the first year, say he is eligible only for 40% depreciation because of less than 180 days. Then in that case, 40% depreciation he will be claiming, and in the second year another 40% will be claimed. Since it is on WDV, on the third year it will come to a minuscule. So 3 years he will be taking the benefit of depreciation. So it is more prudent to claim this deduction under 80IA from 4th year onwards invariably. Because from 4th year again it goes and travels up to the 10 years. By 14th year it will be over within a span of 15 years. Now the department said it should be chosen from the initial year. What is initial year is the initial year in which you start production. Because the section uses the phrase initial year, that initial year is not defined. Initial year means the year in which you operate. It was countered saying, look at 80IB, initial year is defined very specifically as the year of production. Look at 80JJA, initial year is not the term that is being used. The term that is used is beginning from the year in which the commercial production starts or operates, etc. Here it is being given a choice of 10 years out of 15 years. So initial year is the year in which you opt for, you claim. It may be third year or fourth year or fifth year, or if the assessee does not opt for at all and he goes for the 13th year, 13th year will be the initial year. But he will be able to claim the exemption only for 13, 14 and 15 because the 10-year ceiling, 10-year limit within 15 years, so he will be losing the rest. So initial year is the year in which he starts claiming deduction under 80IA is the assessee stand. The department, for obvious reason, they say that it is the year in which the production, so that the much of the benefit is not passed on to the assessee at all. So this went up and we have got Velayudeswamy Mills case at Madras High Court decision. The department has gone against it and it is now pending before the Supreme Court. It is at the stage of admission. It stands there. Now one other way of looking at it is, you are having a period of 10 years out of 15. The wordings that are being used there is initial assessment year, from the subsequent year it applies the quantum 80A5. I'll just read out 80A5. It reads, it starts with a non-obstinate clause, which means it overrides all other provisions. It is for the purpose of determining the quantum of deduction. What is the quantum? How much has to be allowed? For which year? For assessment year immediately succeeding the initial assessment year. For the assessment year succeeding the initial assessment year. So why so much term should be used if it is going to be only the year of production? They can very well say it is the year of production. The succeeding assessment year and all that, why it should come? And if it is not applied like that, everything will start from the date of production and by the 10th year it will be over. So if you travel from back, and if I want it to be claimed on the 15th year, if I travel backwards, I will land on the 5th year. So 5th year should be the initial assessment year, a simple arithmetic. But this simple arithmetic is not being accepted even after High Court order. It is now up to, and again before the Supreme Court, Apex Court. Yes. Then I have 2-3 businesses. Business A making a profit, business B making a loss. Business C is windmill. Windmill is making a profit. The department wants business is one head. So windmill profit, you set off the business loss of business B, and only on the balance 80IA will be allowed. Are you able to follow what I say? Business C is windmill, business B is a loss. So this loss will be set off against the profit of the windmill, and only on the balance 80IA will be allowed. But 80IA, what it says, it is a separate undertaking by itself. It is a separate undertaking for which separate books of account shall be maintained, a separate audit report shall be obtained and filed, and it shall be calculated as if it were the only business for the purpose of 80IA in very clear terms, as if it is the only. As if it is the only business from when? From the year in which you claim the 80IA, that is initial year. Then what is the meaning of that? Supposing I claim it in the 4th year. 6th and 7th year happened to be loss in windmill itself. There was no generation, my finance cost was more, or there was a major breakdown of the machinery, maintenance cost was more, there was a loss. So 6th and 7th year, if there were a loss, that will be continued for the 8th and 9th year, set off, and only on the balance it will be available. That is the meaning of saying that it will be computed as if it is a separate industrial undertaking from the initial assessment year in which you claim 80IA, that is for the subsequent year. So if there is a loss, even if that loss in the regular assessment, it is set off against any other profit. For the purpose of 80IA, you will compute it separately as if it is a separate industrial undertaking and were the only business of the assessee. That is for determining the quantum of 80IA. It does not mean that a loss of windmill cannot be set off against other income. That goes. For the calculation of 80IA, you do a separate working and take that working and keep it under chapter 6A. Arrive at the gross total income. From out of the gross total income, claim all 80s. Your 80A2 says that all deduction under chapter 6A can never exceed gross total income. So restrict it there. That is all the simple exercise. For purpose of 80 HSC, you need not invite 80 IA to come. For 80 IA, you need not invite 80 HSC to come. They are all separate provisions, separately calculate and keep it. But when you come across a case where 80 IA is also eligible, 80 HSC is also eligible, say an export incentive. Both these put together cannot exceed the profit out of that undertaking. Windmill alone is not 80 IA. Say other infrastructure, etc., other businesses are there. Even in a case of a windmill, supposing it happens, a white thing, a thought. This electricity that you generate, you are able to export to another country. If that be, then 80 HSC also will be eligible. Of course, it is not there now. So in such a situation, the total of all these 80s, which are all specific undertaking wise, cannot exceed the total profit of that undertaking. Now, another offshoot from this. Supposing I am the person who has installed this windmill. For 3 or 4 years, I own it. I find I am not able to carry on with it, or I am not desiring to continue with it. The 6th year, I sell it off. One of you buy that. 7th and 8th and 9th year, you are continuing. Are you eligible for 80IA? The opening word says, it shall not be formed by splitting up of an industrial undertaking. It shall not be out of machinery which is already put to use and all that. All these things are to be tested in the first year of the undertaking. It is undertaking means this undertaking has come. How it has come? By a new plant. It was not already put to use. All these things, it was not already manufacturing or generating anything. It is a new capacity addition to the whole country like. So it is a new one that is undertaking specific. So do the test only in the first year, initial year of that undertaking. In the subsequent year, if it is the undertaking itself is transferred, the ownership transfers, the subsequent assessee, the transferee assessee is also eligible for 80IA because it is undertaking specific and it is not assessee specific. For the second assessee, the transferee assessee, it may be a second hand or a used plant and machinery, but it is undertaking. That undertaking is one, there is no dilution on that, and hence 80IA will continue for the 10 years once he has chosen. Now the first assessee has chosen WDV. It automatically, the second assessee also it will come because it is for the undertaking, something has been chosen, it stops there. The second assessee cannot do anything with the change and all that because it is again undertaking specific. So here, so loss of other business I have covered, and I have given a table where how the gross total income has to be arrived at and how the deductions have to be taken. What is not here, I have also explained. Supposing that 80IA undertaking 300 lakhs is the profit, and the 300 lakhs is eligible for 80IA, and also a portion of that is eligible for 80 HSC, means it will be restricted only to that 300 lakh. And the sale, amalgamation, partnership conversion, all these things comes under a transfer. When you do a transfer, what happens is, it is undertaking specific. Along with the undertaking, the benefit goes. It is not along with the assessee. This captive consumption, captive, now here, it will be there. No, it is not it is not derived out of generational, etc. It will be short-term capital gain chargeable.
Sir, whether MAT will be applicable?
MAT is a separate provision. Everything will be applicable. Will be applicable. Will be applicable because you are doing a separate computation under the general tax computation. Even if it is a 100% exempted case also, MAT will be applicable if it is a company. Without it being a company, have it as a sole proprietor partnership, you can escape out of that. That is all the only thing. So these two are totally different two aspects of it. So MAT is a separate concept by itself. This is undertaking specific in the general computation.
And so separate books of account to be maintained.
Yes.
When a large industrial undertaking has got windmill and it is included in the same set of books, then also whether it is eligible or not. We can compute separately. What was the revenue, what was the expenditure, everything that can be, what interest paid on the loan, on borrowed funds, everything can be computed separately, but maintained in the same set of books.
No, again, in the same set of books, if there is a separate revenue account for generation, a separate expenditure for all these things, a sub-head like is being created, and that will form into a smaller profit and loss account that can be prepared. I don't see why it should not be like that. It can well be sufficient, because the meaning and the intent here is you should be able to deduce the profit out of this undertaking separately. Separate books means it is not a separate bound book that you are keeping. The same books, it may be possible, where your subheads and all that is all that what you need. So if the profit can be quantumized separately for this undertaking, why not is the general answer. Of course, no case has come up on this saying whether the same books are there or into this folio it is written or not, etc. That is what it should be understood. Now, quite another interesting thing is, a captive consumption is advised so that you get some better benefits. Instead of selling it to TNEB at 2 rupees 80 paisa, if you are going to use it for your own, you are saving around 5 rupees or 5 rupees 50 paisa, etc. So you get a double the revenue and it is advisable. Now the question is, a unit which uses the power for its own, what is the rate it will adopt as revenue? Because there is no revenue inflow. I have produced 1 lakh units. Should I adopt 2 rupees 80 paise and say 2 lakh 80,000? Or can I adopt 5 rupees and say 5 lakh is the cost of, is the thing? And my 80 IA deduction is dependent on this revenue. So what is this revenue? How I can take? The revenue under, see, you have to very clearly go by this. The revenue under 80 IA separate books is an expenditure in the other books. So in the other books, I claim it as an expenditure. 2 rupees 85 means the profit here goes up. 5 rupees means the profit in the general thing comes down. 5 rupees here in the other books, the wind generation, what happens? The profit goes up. That profit is 100% eligible. So now the department is, why do you adopt 5 rupees? Why not it to be 2 rupees 80 paisa? Why I should accept it as 5 rupees? Or what is the cost for you? Why? If they would come for cost, I will stand much higher, because even 7 or 8 rupees it may cost if interest is also considered. So that's a part. Now coming to this. So then the term that is being used is market value. What is market value? The cost of purchase to TNEB is not my market value. The price that I can sell it in the open market to any other industry, if any other industry would even pay me 7 rupees, that is the market value. In this particular case, what the court said is, If you were to buy it from TNAB, you would have paid 5 rupees 50 paise. So then 5 rupees 50 paise is your market value, the substitution. But going further, if out of the total production I consume say 75% and 25% to the next adjacent industry I am able to sell it for 7 rupees, I can even adopt the entire 7 rupees here because I have proved that it has got a market value of 7 rupees. Of course, that it is not a sister concern, etc., coming into 48 2B clutches and all that. So the market value is not the cost which is for TNAB or the price at which TNAB buys this power from other windmills. It is the price at which this generator, this person who generates electricity, can sell it in the open market. So far so good. Now I come to a crucial question. I beg to differ. I submit. I have a controversy with AS9. AS9, on reading through, this is what I have come across, and I have put it here. It is for you to generate a discussion on that. AS9 says a profit and loss account cannot have both on the credit and on the debit a same transaction. I cannot be a purchaser and I cannot be a seller also. I cannot sell it to myself. I cannot show something as income and the same income I cannot show it as expenditure. So on either side it should not be there, it should be netted off, only the net. So now I buy power from TNAB, my power cost is there on the debit side of the profit and loss account, quite okay. I generate myself, there is no cost incurred. Some maintenance cost, okay, that comes down below in the overheads. So in this case my power cost is down. Though for 80IA I have to compute separately, that is notionally computed for the main profit and loss account as prescribed and as per the accounting standard. I cannot show this 80IA benefit that I am going to claim, the revenue that I am showing for 80IA purposes through separate books of account, etc., in my profit and loss account. In banks, we will be seeing as per contra, bills of exchange sent for collection, contra. That is only a control. On either side, you will have the same figure. That is, under the banking, this thing, it is checks are being received, it is sent for a collection, and till such time that should be a control. So on either side, you will have that. But that is not acceptable for a normal this thing because there is no benefit inflow. Any transaction should be measured by the inflow of in monetary terms. So inflow means, where is the inflow here? There is no inflow. It is self-consumed. So AS9 does not allow me to recognize this as a separate item on the credit of the profit and loss account. Now my submission is, last year I did not have an electric windmill generator. This year I am having. Last year my gross profit was 10%. The industry normal gross profit was 15%. This year, because of the windmill generator, my profit has gone up to 20% because of windmill. See, just carefully let me make it clear. Last year my gross profit was 10%. The industry average was 15%. So I am an underperformer. I am not efficient. I am inefficient. When others are producing 15% GP, I am able to do only 10%. Your financial statement, what is the basic purpose of a financial statement? It should allow you to have a comparative study of myself with respect to the previous years, of myself with others in the same industry. It should help me to do both. Now my own self, the previous year my GP was 10%. Because of this electricity factor out, my GP is now 20%. So if I compare these two, I will claim that I am 5% up other than others who are using wind power, who are using purchased power from TNAB. Now does it give a sense of interpretation? I am weak still. My normal gross profit is only 10%. Because of power, my gross profit is up by 10% and it is now showing at 20%. I should have normally made 25% to say that I am at par with the industry. So with my own self, I am not able to compare. With others also, I am not able to compare. If at all I compare, it gives me a distorted figure. It does not tell me where I really stand. So what is the purpose of a financial statement? It should enable me to have a comparative study. So if this factor is not, then you can ask me, sir, then You have a diesel generator in front of your shop that also produces, that also you work on. You are running, you are using 5 cars. Instead of 5 cars, you engage a outside source. If I am not using and those persons would be using, for everything you can substitute, and on either side you can go on. That can be a probable argument. But now we are also being taught what is materiality concept. Materiality concept here, if I put up a windmill in the case of a company, I should necessarily go to change my object clause of the memorandum of association. My memorandum of association says I will be engaging in this type of an activity. This power generation, if it were not originally there, don't you agree with me to say that I have to necessarily change the object clause of the memorandum because it will go ultra vires the memorandum objects of the company? So it will go ultra vires the objects of the company means it is materially a factor. But the same thing you will not say when I am buying a diesel generator when there is a power cutoff for the electricity for my office, this thing. There is a vast change between these two when though both are producing the same electric power. So there is a materially, it is a different thing. Second, the diesel generator that I am going to have in front of my shop, I cannot sell it to an outsider. It is a separate industrial undertaking. Electricity board itself is buying it from me in big quantum. So it is a saleable product for me. I am not buying it, I am using it for myself. So then, AS9 says there should be an input, there should a monetary benefit should flow inside. My counter argument is it has arrested an outflow. There is a monetary thing. There is no inflow, but an outflow has been arrested. So the arresting of the outflow also should be considered for AS9 is what I have tried to say in this point number 11 in my thing. So that is cost reduction is cost saving, but AS9 where does it recognize it? Notes and accounts and all that are separate thing. What is wrong in saying on the income side profit from windmill? Power cost the same because I am a textile manufacturer or a motor manufacturer or I am into some other business in a separate industry. A garment manufacturer on this, so with other garment manufacturer. So who all have produced what, I go to the notes, I do all this. If I just tabulate it, I should be able to read. Notes and classes can only come as your rules in the Income Tax Act. The basic tax, the act is the crux. That only will help you to understand the things. So still, I believe that this being a separate item which has got a material force in it, it requires a reconsideration on AS9. It is for SARC and others to take up if there is any meaning in my observation and my submission on this.
Excuse me, sir. Can I raise some questions?
Yes, please.
So with regard to this Appendix 1A, the depreciation schedule, what is given as a SLM, if you look at it, it doesn't talk about a windmill generation. It talks about the generation of power. So a doubt comes to the mind whether that Appendix 1A can be taken into consideration for windmill generation.
It speaks generally about electricity generation.
Yes.
Windmill is a mode of generation. You generate power from coal, you generate power from hydel, various gas, etc. So everything, wherever power generation happens, it comes in there. That is why even Mr. Sandana Krishnan was referring that a generator that you are keeping outside in your shop as a stopgap for power cut is also eligible for 80%, he was mentioning. So these things are an electric power. You are having an electric motor, etc., a turbine, whatever it is. They are all related to an electricity act. Basically, electricity act defines so many things. That has been somehow cut and pasted here. That is why it has come.
But the description of the assets, whatever mentioned under Appendix 1A, doesn't have anything akin to the windmill aspect.
Separately,
we find it difficult to group it under what type of assets and some of the depreciation rates.
No, probably it is. Before the windmill concept, that schedule
exactly.
appendix is there.
Correct.
So it is not specific for this.
The next one is you are telling about the building which is adjacent to that windmill tower. So what is your conclusion, sir? That is, it should be
It is to be read as plant.
It's the plant.
It is because you have all the electrical installations, everything embedded into that machinery, that building only.
Okay.
Without that, this windmill itself can't work. It is not that any building is required and any building is required for any manufacture. A factory building is required for manufacture, but it is not that without that thing, that machinery will not be there. That machine can even be on an open. It can work. It can be on a terrace roof. It can be on an asbestos roof, etc., etc. But they are all general in nature. Where what is a plant? If you go by the definition of a plant, you cannot see. I am installing any machinery for that matter. The erection expenditure is also being capitalized as plant only. It is not a civil work.
Exactly.
The installation, what we embedded in the earth, that embedding charges, whatever, it contains much of civil work only. But that civil work is probably under the ground. But that is also a plant only, because all those things are capitalized along with the plant. The same principle holds good for this.
But here, it's only a housing. It gives a shelter, but doesn't add anything to.
No, it is not a
add power.
house. No, it is not a housing or anything. The nature, if you look into a powerhouse like that, powerhouse for these windmill which stands on open, all the cabling, etc., are only through that. So that is a must for thing.
Okay, sir. Fine, sir. Thank you.
Next, I proceed to wheeling charges. Now, what is this way? I had a very interesting, a sudden shock, like when an housing officer asked me, wheeling charges, you should have deducted tax at source. You have not deducted tax at source, hence I am going to disallowed it. Suddenly, where from he got this, I was taken by surprise to think. Of course, holding to myself, I was able to give an answer that is different. But suddenly something like this sparks up, a new thing comes up. What is this wheeling charges? I have my windmill in, say, Kanyakumari. I have my factory in, say, Coimbatore. The windmill generates at Kanyakumari, and the TNEB, I have entered into an agreement by which they take that and they allow me to draw it here. This distance is the transportation what TNEB does for me. So to get that electricity generated by my unit at a distant place to my factory at a different place, it is a transport charges, or they call it as wheeling charges. So this wheeling charges, they deduct 5%. 100% is my 100 units is my production, means I am permitted to draw 95 units only. 5 units I lose. This is the charges, no monetary payment is being made. So in the bill it will come, so much is my electricity consumption, your unit has generated so much, less 5%, the balance, that balance is set off against my consumption, and only for the balance I am going to pay. So with all electrical data, electricity consumption data month-wise and all that is being given, he said, there is a deduction of 5%. For this 5%, you should have deducted TDS. So immediately the first thing is TNEB outside exempted category? Is it coming under government? No, it is a separate body. So it does not go under the exempted category. Then the second thing is, sir, I don't pay anything at all. It is the department, the TNEB which pays me. I produced 100, I consumed 50, the balance 50 only they will be paying me. So I don't pay anything, was the second thing. That was also not going. Then a bit of further study said, any sum that is being credited or paid to the assessee, to the service provider. So there is no sum credited or paid. There is no sum, the monetary value. What is being deducted is in kind, in quantity. So 100 units I produce, I am getting 95 units. 5 units is a barter system like, or it is in kind. So there is no sum either credited or paid. I account for the net 95 only. Hence this wheeling charges this will not attract TDS provision, is how it was taken up. Okay.
So, like what you said, yes, company A as the wheeling charges was deducted by bill by unit. But between A and B, when they pay when the settlement comes, A bills B.
No, it won't also come because.
That has come
No, it won't also come there because A producing 100 units, with various permissions, B was entitled or permitted to draw the unit produced by A. But from A to B, it goes through TNAB. It takes 100 from here and it gives 95. So as regards TNAB and A, he gets that 5% in kind. There is nothing from TNAB to this B, no payment or nothing. B pays A for a sale of consumption or for the sale. There is a sale of electricity. So TDS also will not come into that. No, even there is only a quantum of in kind. There is no monetary value that is being credited. It is sale of 95 only. Sale of 100 is not there. When I shift it there, it is 100. When it reaches you, it is 95. You pay only for 95. Bill is raised only for 95. Please do not raise anything as billing charges. If you are raising a separate bill, debit note, etc. as billing charges, yes, TDS will be attracted because it is some paid or credited, etc. It comes into that. You take a net, it is like a trade discount. You sell something, you give a discount, you account only for the net sale, that is a trade discount. Equivalent to trade discount is what it happens. At least in trade discount, there is a value. Here it is totally in kind, so TDS will not come into this.
Sir, I have a question.
Yes.
Can a single solitary windmill can be treated as an electricity generating company?
True.
And if so, does it require any industrial license? I don't think anybody can start a generating company without a license.
Yes.
Okay, if that is the case, now you have referred to Jindal Power. Jindal Power probably will generating electricity.
Yes.
I don't think that we can apply to general, any other companies which be putting, 1 or 2 windmills. And secondly, even that schedule is applicable only to a power generating company. But if I say, no, I am a normal person, I am installing for my business, and I earn some miscellaneous income, and therefore, I come under the normal provisions. Why should I, get into the controversy of whether 8.24 is applicable or applicable at all?
No.
Straight away, I will say 80% is applicable.
No. First, basically, it is like this. The law does not distinguish between a big manufacturer and a small manufacturer. The law is the same for Reliance doing some fiber yarn and me doing a fiber yarn in kgs and they doing it in tons.
No, I'm referring to a license.
No, I'm coming
There
to
should be a
that.
license that will be
Yes.
required, for you to put up a generating company.
True, I am coming to that. So, the law nowhere distinguishes between a big manufacturer and a small manufacturer. Electricity is generated by Jindal. It is also electricity is generated by me having one 250 kV power windmill. We both are entrepreneurs producing the same product. He does it in a mass scale, I produce it in a small scale. That is all the difference. The law is same. What is the license? Under the Electricity Act, that is why I said electrical engineers come and inspect and certifies that this installation is proper and power can be drawn, and I am dependent on the State Electricity Board to draw the power and give it to me wherever I want it. So for this purpose, whatever is the required license or whatever is there, it is being taken care of and it is being obtained by everybody. All these things
So,
as
but
an
that-
outsource,
so
just
that-
a minute.
that
All
might-
these things as an outsource is being done by the manufacturer of the windmill itself. They take charge. You pay him 1.1 crore for a 250 kV means he installs and gives you the certificate. Everything he takes care of. You are not even knowing as to what are all the things that he has done. Everything, right from security to everything, he takes care of. That is how it is being operated. It is so very easy for any common person to install a generator, wind electric generator, only because of the manufacturer is assisting them in total. I will not be even knowing which is my windmill because there will be 100 standing. Which is the one, he has to come and spot and identify it. Next time I go there, I may not have again able to find it out. Only he has to come and identify it. Of course, there will be some numbers and all that is different. So that is how it is being done. The license part, etc., whatever is there under the Electricity Act, everything has to be satisfied and a certificate is obtained from the electrical engineer of the concerned state board. They take care of that. And I am a normal person, it is just like a normal activity, I cannot say, because it is treated as a separate industrial undertaking. When you want to shift it also, the 10-year benefit is being given to you as a separate undertaking, as a separate unit. If you do not want that 80% and all that, you go in the normal thing at 15%, nobody will bother about it. You do not go for that industrial undertaking at all. A normal plant will get you 15%, so you go with that 15%. All these things can start only if you want 80 IA, and if you want that higher depreciation at 80%. That 15% plant and machinery, yes, this is also a plant and machinery, you can go in that channel. But that does not give you any benefit.
So that higher depreciation is given to all the other units. The controversy of 8.24 comes only if you're a generating company, because you come under the other provisions of depreciation, where it is generating company, then SLM method is applicable. And only where SLM method is applicable, and if you want to claim 80% in WDV, then you require that option to be exercised. Otherwise, for the normal company, it is only 80%.
Please read section 32, subsection 1, class 1. That class 1 says by default for power generating units.
SLM.
For power generation. So you are generating power means SLM straight away comes and stands there by default.
No,
you don't have an option to go for the, you have got the option only if you exercise that option. That is what I was trying to say in the initial opening part. It should be the other way. Any generation, because see, even the, how it has been arranged, you look into it, 32 subclass 1, subsection 1 says about power generation. Subsection 2, subclass 2 only says about the normal what we adopt 80% depreciation or 15% depreciation on WDV. WDV is mentioned in subclass 2. Subclass 1 precedes it. Subclass 1 speaks only about power generating units. So once it is a power generating unit, straight away SLM comes in.
So that
You
is
don't have
only,
an option.
So that's why only if I call myself a power
No,
generating
it is not
unit,
your
if I
question.
say I'm a normal unit, I'll wheel the chargers, I'll use it, how does it come?
No.
So,
Normal unit, if you say you cannot call in one side I am a normal unit and another you cannot come and ask for 80 IA.
Sir, 80 IA is a myth, because you yourself said that it's 12 years is going to be,
True.
and 15 years. I don't think anybody will be able to claim 80 IA in a power generating unit with a windmill.
True. That is the practical part of it. Financial part of it, the opening part of it, claiming 80 IA is a myth. As a standalone unit, it will not work. You are not really getting any benefit for the return. It is beneficial only if you have other cash-rich company where you are making profit and you want to set it off against it, and also you want to self-consume it. You are consuming it means, as in the Jindal case, you apply 5 rupees rate here and adopt 5 rupees in the other one, where your profit in the other unit will come down and the profit in the generating unit will go up and you get to 80 IA. So you have to work on those fundamentals on the financials for that. Then the last one probably will be the carbon credit. This carbon credit, yes, it is a revenue which is a taxable income, and you will be taking it as section 28 will be attracting on that. So the conclusion probably I have covered in my opening part itself, where in Bajaj, I will just read out that part, a provision in a taxing statute granting incentives for promoting growth and development should be construed liberally, and since a provision for promoting economic growth has to be interpreted liberally, the restriction on it too has to be construed so as to advance the object of the provision and not to frustrate it. So this is what the Supreme Court has opined, but it is seldom being followed, and every little issue, much trivial issues, is being taken to the court at the cost for the assessee, at the enjoyment for the department on public money. With this I conclude. Thanks for your patient hearing.
Excuse me, sir. So one clarification. Sir, say if it is for captive consumption, own consumption, and the wheeling charges of 5% is being debited by TNEB, then whether I have to claim revenue as 100 rupees, say 100 units, and then usage as 95, then what about this 5?
It will be only for 95, because what you are getting as production, in the production process, you get what comes into you is only 95. though the meter reading for TNEB purposes, he being your, say a trustee like, he is your trustee who is being entrusted with the job of collecting your production and giving it to you, for which he is being paid a service charge of 5% in kind. So from his accountability point of view, he says, I have produced 100, I have deducted 5 and I am giving you 95. That is only a calculation that he gives to prove himself that he has done as per the agreement. As regards you, what you receive is 95 and that will be your generation itself. Yes. This carbon credit for this not to affect the ozone or the atmosphere, etc. By burning the fossil fuels, whether it be oil or coal or anything, so much of carbon dioxide is emanated and so much is thing. You are aware of Hankian obligation like? These are all at par. In Coimbatore area, we have where textile mills, I'll just relate it. Textile mills, they are by statute to produce something as hanks and something as cones. Cone is the yarn which goes for the industrial production. Hanks is one which goes for the, you will be seeing weavers doing the petty part of where hand weaving, handlooms, etc. So this handloom sector also to be protected. For handloom sector, some hanks are to be available. So if everybody starts manufacturing only cones, handloom sector will go off. So there is a direction that at least some 20% of your production should be for hanks. There will be some mills which will be producing only hanks. So those mills which produce only hanks take the obligation credit. You have got surplus, that surplus is tradable. Like that, this carbon credit with all your international union and all that, in Europe you have a body there. So if you are producing so much of electricity without using these fossil, so much is the credit. Somebody else is using, say Bharat Petroleum is emanating so much carbon dioxide into the atmosphere. So they have to buy that from you to equate it. So in that process, Bharat Petroleum may pay you for the carbon credit that you are giving. If only you transfer, it is an additional income for you. You have to make a claim. You have to make a claim saying that I have installed a windmill. These are all the production I have made. By this production, I have avoided so much of carbon dioxide being put into the atmosphere. So this, if you are producing more, you can take it, for which it's a, no, the other person will pay for you. It's an obligation transfer. Yes, yes. It is a big process. Yes, yes. Each one. Supposing this year you put one and the next year you put another and the third year you put one another. Or in the same year you put 3. Each one can be treated as separate one. For the first year, your initial year may be third year. For the second one, it may be the 5th year. Each one is a separate industrial undertaking. You can take it. Yes. No, there is nothing in law like that. The subsidy is a separate aspect. Subsidy, sometimes state government for encouraging, they may pay. If that subsidy is of the nature to reduce the cost, you have to reduce the cost and only on the balance you will be eligible. But that subsidy is for a backward area thing. Depends on the scheme of the subsidy. If that is for a backward area promotion, then it will a total capital receipt which can be added at a later date to your capital straight away.
Renewable energy. So that give a subsidy, there's a requirement that the company cannot claim the accelerated depreciation. So they have to go in for straight line, SLM straight away. They have to get an undertaking so that the company cannot have the double benefit.
No, I am not able to
So
get
it's
you.
a power manufacturing company.
It is not on. It is not related to windmill.
Windmill, sir. I'm telling you about
windmill. Okay.
Windmill is
Renewable energy.
Renewable energy, the board or the authority,
Okay.
where the company goes for a subsidy claim. There is a requirement that the company have to give an undertaking that they don't claim an accelerated depreciation, namely 85%, 80%. So there's a company has to.
It's a subsidy granted by the central government.
It's a renewable energy authority. There is a separate authority.
From the central government.
And even they have to take an auditor certificate to confirm that.
Okay. I'm not aware of it. if there is a separate thing and it is not a state and it is a central government thing, and where they want you that I'll give you only if you do not claim that means, then you are
It's
restricted.
something
to
like
that.
in the central excise where you have
Yeah, send back credit, you give it away and only on the balance same thing. It will be applicable like that. Tax planning, that's what only rich companies who have got other businesses, they can go for it. As a standalone, if somebody would go for it, he has gone with the wind. The act is silent, but again it is being linked to class 2. That class 2 is under 32. So it will be 50% only. That is how it goes. It is 50%.
Sir, one small opinion I have. Sir, here.
Yes.
Sir, this with respect to this carbon credit, I feel that when I transfer a carbon credit, I need not pay tax because the carbon credit to the buyer, it gives some kind of a right to emit so much tons of carbon. Okay. So now when I transfer this carbon credit, to me it's a capital asset because it is neither a stock in trade. It's not my stock in trade. Okay.
No. The question is, everything is an income to you, it is revenue. You have to do an extra exercise to say that it is not income to me. If your friend gives you a gift, it is taxable. Earlier, it was exempted.
We adjourn for lunch and we will be back by 2 o'clock.
You have to go to prove that it is not my income, it is of a capital in nature. The one among that is this capital subsidy for backward, etc. This carbon credit, you have done an exercise, you are earning it, there is no capital receipt in it.
So I have a
anything
right-
that comes to you, whatever right or whatever you sell, you are not selling a capital. What capital you have by holding it? You
No.
only lose that.
I understand, but the definition of capital asset is so vast that you can cover virtually any asset. It's like any asset other than your stock in trade or your gold bullion or agricultural land in a rural area. So there's just only this negative list. So I feel that
Being presented, and the first day itself